So for equity, we will not have accrued interest, but for bond, you will have accrued interest. So why? Because the accrued interest is you have to pay when you sell to another person. The other person have to pay, or when you buy the other, you have to pay for the another accrued interest to the seller. But for equity, this is the actual amount. So that's why when you trade on the price, this is actually worth more on bonds normally. But for the default bond, that will be a bit different. So, but in terms of valuation, what does it mean is that in this case, you're including the unrealized capital gain and etc. So what does it mean by unrealized capital gain? Say for example, you bought it at $7. So in $7, actually you worth 1.025 million, but your cost is a lot lower. But you still have to show the mark-to-market value in order to reflect the true figure. So to cut it short, the return, the portfolio of the market value portfolio means that if the market under normal circumstances, you can sell everything and get back equivalent of cash at the valuation. So that's why we have to reflect the true figure. If all are liquid instruments. So that's why you will see that sometimes the market will have discrepancies, especially on the equity market, because it is not truly reflected. So what will happen in terms of calculating the market value? What will happen is that if in the interim I have cash inflow and outflow. Say for example, like this in this case, on January 1st, I give 1 million to the banker, and then on May 1st, my market value become 1.1 million. And then on May 1st, I inject another 200,000 because I think he's doing better. And the end of the December, my market value will become $1.3 million. So what should be my total portfolio return for the 2011? So that's why in the beginning of the year, I give him 1 million, and then on May he told me that now 1 million up to 1.1. Okay, so that's why I give you another 20,000. Seems to be good, but in the end of the year I got 1.3. So what will be the return of the portfolio? So if you look at the total number, it looks like that 1 million, I give 1 million, at the end of the year I get 1.3. Does it mean that my return is 300,000? No, because I give you another 200,000, then my return is only 100,000. But is the 100,000 divided by 1 million or 1.3 or in between? You have to know the mechanic how to calculate to reflect the true return. So if no income cash flow, say like this, if there's without this, your return will be 30%. So from the manager's perspective, the return is 10% because he makes 10%. But from the investor's perspective, it's only around 8.3%. So what is right? So who is right? 8.3 or 10%? What do you think? Because if you look at that, day one, you give me 1 million. I make 1 million, 1.1. So it seems that I make 100,000 for you. So I give you 10% return, right? Then you give me another 200,000. I make 0, because from this will become 1.3, and then the end is 1.30. So I still make 10% because start with 1 million. Looks right. However, actually it doesn't so right, because the client said that I give you another 200,000, but you make nothing, and then I waste my time. So we have the time cost to wait on that. So that's why this is how it's being calculated. To be fairly calculated is that the time according to the CFA Institution in Study Field, that's a standard calculation. So we call it the time weighted return. Say because time doesn't just cost money, cost value. So divided the period into 2 sub periods. So for the January and April, so it's minus 10%. And then for the May to December, I get 1.3, and then minus by 1.1 to start, I have 18.1%. So if you calculate this on a compound basis, it should be 6.36%. So it can be shown by this chart. So on day one, actually drops here, and then you get back, you give you to another 200,000, and then you move it back. So it looks like that is from here to here. If there's no cash flow inflow, but since they have a cash inflow, so that's why we have to, on the first couple of periods, on the first couple of periods, it is down 10%, and then after injecting 200,000, it becomes up to that level. So that's why we would, this is how we calculate the weighted return. Sorry? Let me see. Okay, sorry, I different. So it means that in the CI, that means it's not in the May to invest it during this time period. He invest to up and then become 1.1. That means he from 1 million he down to 900,000 and then increase to 1.1 to inject. So in the beginning of the period it's 1 million. So and then with the injection of 200,000 he become 1.1. So 1.1 then grow to 1.3. So actually, it will be a bit different in the past, but again, the return will be different. However, the actual return will be the same, but the return rate will be different. So we can calculate, according to my interpretation, we can calculate again, the total return will be different, but actually the amount will be the same. But however, in the example is that, in the beginning, so I think the chart illustrates better. So, so in the beginning of the year, he gave him 1 million, and then in the end of the first period, it drops to 900,000, and then the client inject another 200,000 to him. So that's why he from his starting point is 1.1 up to 1.3 again. So that's why he's lucky that he get injection. Otherwise, he would not make that much. Because the principle to invest, say for example, without the injection, his total return will be less. Oh, the return will be the same, but the actual amount will be less. Because the principle, say, if he return, to assume that no injection, the result will be like that. So that means it will maybe around 1.8 million. So that's why that if you including the calculation of the injection, the total return will be the actual amount will be the same, but the return rate will be different. So that's why in the presentation of the results, we have to look at the actual amount as well as the rate. However, there's another method to calculate. We call the IRR. So everybody know how to calculate IRR, right? So IRR is difficult to just pure calculate, but in your computer you can calculate that. IRR is the 1 plus the IRR plus the 200,000, because it involves different time period. So first IRR is different from the second IRR, and then the total absolute front cash flow is like that. So, and by solving the IRR is 8.84%, so which is correct? So should it be 8.84 or 6.36? What do you think? Which one is correct? If this is an exam, I ask what's the return of the managers.
8 point.
Which one? 8.84 or 6.63? 6.36. Who voted for 8.84? Who? No? Who voted for 6.36? Everybody had at least voted for once. I want to see your concept. 8.84, anybody? I vote for 8.84. 8.36, I vote for 8.36. Actually, both are right. Depends on your calculation. So that's why you can see the difference. The absolute amount is the same, cash flow is the same, but the return is different. Depends on which method you use. This is not a trick, but this is actually what happens. So that's why in some cases, we will use the IRR to reflect the true picture. In some cases, we will use the weighted, time weighted. So that's why there's no a single method if there's a cash flow calculation involved. But however, for longer term investment, we will prefer use the IRR, especially when the cash flow project is very irregular. But for the normal investment return, portfolio return, we will use the weighted return, especially for fund management, for asset hedge funds or fund management. We will prefer using the time weighted, because time weighted will represent the opportunity cost. So this is talk about the time weighted return versus the internal rate of return. So fund managers should not be penalized or credited for the timing of the client-induced deposit or withdrawal, because the client's injection of the money and withdrawal money is not under my control. It's because of the client's decision. So that's why we will use the time weighted return. So the time weighted return will neutralize the impact of the client initiate deposit and withdrawal to an account. And then the absolute amount will be determined by the client when we want to inject the money. So that's why the Global Investment Performance Standards of CFA Institute require that the time weighted return will be used when presenting performance data to prospective clients. The difference between time weighted and IRR are generally modest if the cash flow are relatively small or income volatility is low. However, the contrary is high because if the value of the volatility is high. For PE and real estate, IRR is recommended because the cash flow costs are made by the fund managers through cash call and liquidation. So this is the main difference. So fund manager can provide both calculations, so in order to mitigate the differences. So make sure that let the client knows what's the difference on calculation. But the absolute amount is the same. That's why in the private equity, we always want to use the MOI, the multiple of investment. So that's why, say for example, the MOI is 2, that means I put in $1, I get 2 times back. So the MOI will reflect the absolute gain of the portfolio. However, if you achieve the MOI, the shorter the better, because that means your IRR will be higher. But however, a lot of the private individuals will always like to look at the MOI instead of the return, because sometimes So why it always used in the MOI on, especially on the private equity, because you know that last week, remember Mr. Young, Albert Young talked about the private equity. A lot of people, when they invest in a company, they already visualize the exit value of the company. Say for example, invest in a company in the amount of, say, like one-time scope. So after the enhancement, operational procedures, and then the expansion, etc., they expected to sell the market at 2 times. So this is usually they will achieve 1 time of the book when they invest in the private equity deal. Whether they will be selling it earlier or later, it will be depending on the macro environment. If the macro environment is better, he can sell it faster. When the macro environment is bad, he can sell it longer time. So say for example, if he expects to sell it like 2 years for 1.5 times, the ROI will be reasonably okay. But during the COVID, because everything slowed down, he cannot sell it, only sell it after year 5. So the MOI is still the same, but the ROI will be a lot lower. So, but however, people are still happy because this is achieving his original MOI. And then when they calculate the performance fee, it's still the same. Because if you talking about say like 20% of the absolute return gain. But due to the fact that in the industry, people will try to equalize the opportunity cost. That's why for private equity manager, they will give a term that they will give a preferred return for the investor for the IRR, so that they will penalize the manager if they cannot exceed the investment in a timely manner. So that's why it is some kinds of the mechanics or the how to say, the negotiation after many years. People try to find out an equalization of the risk and reward terms for the manager and also the investor. So after calculating the absolute return, then we will want to know, is the say for example on the previous example, 8%, is it good or bad? So if you compare when this is 0 interest rate environment, 8% is good. But when the year treasury right now, you should buy the treasury bill, you get 5.25%. At 8% is not very good. Because I'm doing nothing, I will earn 5.25% already. Why 8% is good? But in the early days when the interest rate is so low, like 0%, you have to take additional risk in order to achieve 8%. That's why we have to again compare the existing environment or existing market environment in order to see whether the manager is good or bad. That's why according to Bailey, Richards, and Piney, which has been a long time ago, 2007, and then they will try to identify what a valid benchmark. How do we use a benchmark? So yes, these are the credentials to determine which is a good benchmark or bad benchmark. Say for example, earlier I said that when you invest in Hang Seng Index, when you invest in Hong Kong stock, do you think you should use an S&P as a benchmark? No. So if you invest in Hong Kong stock, you should use the Hang Seng Index because you compare apple with apple. If you think that if you invest in treasury bonds, you should not use equity as the benchmark. So a lot of people we call it will be misled. A lot of investors will be misled by the banker or the investment manager, or some of the investors will, in order to achieve the better result, they will give a wrong benchmark for a manager to invest, but it doesn't match his risk profile. So that's why in the determining of the portfolio, we have to understand the risk profile and then use the right benchmark. So that's why, and then these are the definitions of benchmark. The benchmark must be unambiguous. It's very clearly defined. So that means it is very straightforward, no ambiguity. Is it investable? So, but later we'll talk about whether it's investable or not. But sometimes you still use some uninvestable as benchmark, but as a reference. But then it's not a benchmark, it's a reference. So if you be investable, that means you can invest on that specific benchmark or similar thing. So measurable minus, and then they readily calculate on a reasonable frequency basis. That means you're easy to get the information of the benchmark and consistent with the managed investment style or area of expertise. So that's why it's very important. It must be consistent with the managed investment style or area of expertise. I would like to say in also the risk profile of client. And also the reflection of the current investment opinions. So similar like that, the reflection of the current opinions. Say for example, like, so what are the common benchmarks? Where widely used benchmark in nowadays? Like there's okay, we have cash, fixed income, equities, hedge funds, PE. These are the biggest or commodity. These are alternatives. So these are the big asset class. So what do you think will be the cash benchmark? If assume you're US investor. Okay, people would like to use the 3-month US Treasury bill yield as the benchmark cash. Because if your US dollar cash, this is the one you invest, you will get risk-free or basically no risk on that. So that's why they will use the US benchmark. And then fixed income depends on the environment, but for the global, assume it's a global, we will use the Barclays Global Aggregate Index. This is an index created by Lehman Brothers, but Lehman Brothers was bankrupt, so it was bought by Barclays. It's a global aggregate index, means they incorporate all the global corporate bond, government bond, etc. They have a corporate and a government index, but I just use the global aggregate index, it's a global bond index, cover all most of the bonds. Although, so we may have also like US Treasury long dated index as a sub, but this is only related to long dated US Treasury, so this is more widely used. And probably some of the emerging market bonds. These are the sub benchmarks. For equities, MSCI World, because MSCI will cover all the indexes globally. But however, if this is US, people will use US S&P 500. If Hong Kong, people will use the Hang Seng Index. Or if in Japan, people may use the Topics Index, or etc. So that's why something all this, and then hedge fund, that's called the there's a hedge fund, universal hedge fund index, but I put it bear in mind that this is a reference. Because this is, I will tell why this is a reference, and PE also is there's somebody created this PE index, also as a reference. Commodity, sometimes we will Goldman Sachs Global Commodity Index. GSCI, Global Commodity Index. So I can say that the one I mentioned here, all these are investable. These two are uninvestable. But we still like to use it because as a reference, people will know what other people are doing. The reason why, because it's investable, because you cannot replicate a performance of the HR hedge fund index, because some of the hedge fund is not investable when this is closed, or you cannot not accessible to individuals. So and then PE same thing, but if we can all get the data as a reference, so you can see somebody, say for example, you invest in KKR's private equity, and then but it has been closed, that's why you cannot invest. But for these, for the liquid assets, for all the liquid investment, all these are investable. So that's why these are good benchmarks. And then nowadays, because most of these benchmarks, they have ETF, like S&P 500 index ETF, Hang Seng index, the Tractor Fund Hong Kong ETF, the K225 ETF, or like MSCI World ETF. You can always find it, reference ETF. And then, who are the biggest ETF manufacturer right now? Do you know?
Vanguard.
No? BlackRock. So actually the biggest one is BlackRock globally. All the iShares belong to them. And then Vanguard is also very big, but mainly more on the US. They have used a lot of sector ETF sector. And another one, some SBDR, this is a smaller one, and then Goldback on some of the investing. So you can always go to the website to search, and so I will talk about it on the manager selection later on these things. So however, that's why when you want to find a benchmark, then you have to find something which is investable. So up to here. So how do we determine what benchmark to use? So many benchmarks. Say for example, if you have a client investment mandate, okay, 50 fixed income, 50 equity, and then global diversified. What do you think? What are the benchmarks to be used according to here? If the client want to invest in investment mandate, I want a 50% equity, fixed income, 50% equity exposure, and then want to globally diversify. So what do you think will be the most appropriate benchmark? Anybody guess?
MSCI and
Okay, MSCI World
and
will be equity.
yeah, and Barclays.
Global equity will be the bond. This is the most straightforward thing to as the benchmark for these portfolios. What if they say, okay, if my investment mandate is that the client A is a Hong Kong Chinese, and then his investment mandate is globally diversified with home bias. So if the investment mandate is 50% fixed income and 50% equity, but I would like to have a global diversified with home bias, what do you think will be the benchmark to use? Say, home bias for a like 20% home bias. What does it mean by home bias? It means I would like to invest a bit more on my domestic market, which I know more familiar. So what would be the home bias thing? So in this case, I would suggest say like for the fixed income, you can have the Barclays Global Bond Index with you can discuss with that. I would add 10%, 40%, 10%, 10% is the Asian bond index for Asia. For the MSCI, I will still take 40%, and then I will 10% put it at Hang Seng Index. So I will weight it with 40% MSCI World, 10% Hang Seng Index, and then 10% Asian bond, and then 40% global equity. So this will be a bit tilted to the home bias. So this benchmark is not me to dictate. You have to discuss with the client. So discussion process is that, should I use this benchmark or should I not use this benchmark? Because this will dictate my future reference on performance. And then think about that. Remember that when we find a manager, I want it to outperform the market. So that's why this is the case. But however, if in the discussion process I already wrong that Hong Kong, China is bad, so then the performance will be worse than MSCI World. In that case, if the client blame me why my performance is worse than the 50-50 benchmark, okay, you can say that because you want to some home bias. Unless you change the home bias, then I will not invest in the Hong Kong and Hang Seng Index. Or if I'm being the manager, despite the client want a home bias, I still not invest in Hang Seng Index because I have a strong view that it is bad. So I will outperform the benchmark by giving the client a high return. So this is something that through a negotiation or through a discussion with the client, but make sure the client understands how it comes from. Otherwise, you will never be able to compare apple to apple. So because the manager has some decision to make, either he suited the benchmark or following the benchmark as a whole and outperform the benchmark. So, and then we will have some calculation later to determine which one did it better. Okay, the benchmark is to guide, to give the benchmark comparable. So say for example, if I'm the client, I don't want to hire you as the manager. I can buy according the ETF. I do it myself. But in this case, I'm static because that means I will not take any bets on the deviations, and then I will not say if the Hang Seng Index some of the stock I think is bad, I cannot afford it. But for the manager, he can choose overweight something and underweight something to outperform. So that's why when you hire a manager, you want him to outperform the benchmark. At the same time, you want him to do a better allocation than the benchmark allocation. There's a two level of. So remember that so this is not only on the teaching, on the real world. On the real world, okay. Maybe investment involves two elements. Strictly speaking, investment is only two elements. If you have $1 million, you have to decide whether you're in or out, and then what. So if say for example, if you decide to out, the what doesn't happen because you decide not to take risk. This is in or out, that means whether you want to take risk or not. So whenever you invest, you are taking risk, and then you will take, and then you decide which risk I would like to take. So say for example, if I would like to invest in benchmark, that means you would already like to get in the market. And then if you say, I just buy the ETF, that means you forget about this one. But if I don't want to use ETF, I want to find a manager or I choose my own stock, then it is your decide to whether you would like to do better than the market or not. So this is become the beta and the alpha, because you remember about the risk and the opportunity on the investment. So the first one is whether you would like to take the beta or not. But disregard your investment, it is a decision. Say for example, if you don't want to invest now, and you want to invest 1 month later, you are taking a view that the market is going to be going down. That's why I don't want to invest now and want to invest in later. So remember that all the investment decision you decide, you must have a view. Somebody say that I don't want to invest, I do nothing. Wrong. If you do nothing, that means you are bearish. Because the market is opening and then moving every day. Say for example, if I put all my money into the deposit, getting 5 and 40%, it's already things that you already think that cash is better than other things. Right? So just like you're taking a bus, say you're in your Causeway Bay, you come to University of Hong Kong, you have 3 choices: walking, taking MTR, or taking a taxi. Right? There's only 3 ways to go. You cannot take helicopter, not available. So if you think that there will be a traffic jam and there will be an accident in the MTR, it's better walk. You should know that. Even if under normal circumstances you have enough time to take the MTR, but you know that you have to wait a long queue, want to get out, then you better take a taxi. So you know, this is the same case like investment. So or you think that you don't want to come to university to take classes, this is another decision. So that's why everything must have a decision as a reasoning. So to cut it simple for investment is that's why you have in future you will learn a term called risk on and risk off. When you take the risk, you're risk on. When you invest in something, you risk on, you something on risk. However, although I say that when you're taking cash and not invest is also making a decision, but people still need to take a how to say not benchmark, it's a starting point. That's why people use always right now the financial market always people use US dollar cash as the starting point. This is I don't think it's truly right, but based on the global capital market situation right now, US dollar cash is the starting point. So that's why if you look back in the financial history, during the financial crisis in 2008, all things goes down except one thing goes up. It's US Treasury, 3-month Treasury bill, because everybody put all the money back to basic, back to zero. It's US dollar cash. Because at those days people think everything will go down. That's why they want to buy something that or keep holding something that will not go down. It is cash. But however, when the things turn around and people getting excited or optimistic, nobody will like to hold cash because nobody want to hold cash because they think other thing will go up. That's the decision. So that's why the risk on and risk off theory is like that. So the page here like that is that we want to know about the benchmark. So that's why when you go into when you go into mutual fund prospectus or mutual fund performance evaluation, they will always have a chart of the fund and also have a benchmark index. So you have to look into the benchmark index whether it's appropriate or not. If it is an equity fund and then the benchmark is a 3-month Treasury bill, then you never buy this fund. That means they use the wrong benchmark to tease you or mislead you. So that's something that you have to know about. If it is a US equity fund, it gives you an S&P 500, it's appropriate. But if this is a US healthcare fund, and then it gives the S&P 500, I would say 50-50, because it should also give you the S&P or the global healthcare index as the benchmark. But seldom funds will use that. You know why? Because a lot of funds are underperforming the ETF. If it always show you that they underperform, then why do you want to buy the fund? So that's why I think it's a smart investor in future. You have to learn about how to take out the noise of the marketing material. So and the benchmark must be specific in advance, and then the accountability of the benchmark. So MSCI and FTSE has a widely used, and then the broad index such as S&P 500, Hang index are better. So ETF can also serve as a benchmark sometimes for evaluation of fund managers. That's why I always like to use that. I would use the ETF to compare with the fund managers. Because if, for example, if I want to buy a global healthcare fund. I just compared with global healthcare funds manager and compared with the tracker, or the ETF, the IHJ, which is the International Healthcare ETF. The reason why, because it's more liquid and then transparent. But we do see some of the fund managers, they do outperform the ETF consistently, despite they may have high volatility. This is something that our job to find a good or better manager to outperform the index. So, okay, we take a break first, and then we come back to talk about the risk measures.
这个留学生的签证。哦，是伦敦这里。哦，有可能，反正并没有。我当时看到他们是。这个好便宜，但是要飞33个小时，这多少回事？我也是，那个时候不是疫情刚开吗？然后保安员是6000，保安员4500。为什么？因为我们不是我们按套飞的，我们是先飞到土耳其待了几天，对，就我们分开2程嘛，加起来4000。因为我当时好像比这个贵一点，好贵，但是好像是美国贵多了，我疯了已经。不要。就我那个应该已经是8月，我现在买的是8月20最后一天，我现在买的8月24的，就49多，而且有46公分的行李。我就说明天是什么题目是什么？要么是胸题，要么是消题。他们俩知道吧？知道吧？我看一眼，明天是什么题？应该是肖总，不是苏总。艾特他一下，我单独的吗？我就按照这样子，他说怎么翻呢？就上面是反正拍 A 就可能可以用，那他是我真服。那就是拍 A 就那我这 computer 什么有一个那个 Mac 那好像对83分，86。他说正在做，我又喝这个东西，我又想上厕所。这个妆又拍这个东西，我在妆来着。是下个你怎么安排完？我先去聊一下，我觉得我们可以上班。看他的一个行李箱，然后那个颜色它是只有欧洲有卖的，全世界找不到。 对他几乎80年，然后我觉得他在
Okay. To illustrate a bit more on the time-weighted performance. So here, assume there's a manager. What he do is that he starts his portfolio with 100, and then year one he's down to 90, and then this is index, and then he's gone to 100, 110, 120, and then go back to 110 in the year 5. So assume there's two clients. Client A, in starting the year, both invest $1 million with the manager. And then on the client A, he invests 200,000 in year 1. And then year 2, he put another 200,000. And then year 4, he take out 400,000. So net. So under this case, both net invested 1 million into this manager. So can you calculate what's the total return for these two managers? Very simple. So how to calculate it? Okay, let's take the easier one. B. What will client B will have in year 5 if he invests in here, and then after the cycle, what will he get?
110.
Yes, 1 million and 10, 1 million, 1.1 million, right? How about 5? This one, a bit complicated, right? Let's work it together. So we start from 1 million. And then in the beginning of year 1, or end of year 0 or beginning year 1, the beginning value is equals drop 10%, become 900,000. And then he invests 2 million, then 1.1 million. So 1.1 million from year 1 to year 2 go from 90 to 100. That means his principal will be 1.1 times. How much return? calculate. What's the return? For
122.
122.
Then complete the million.
Oh, this is the end of year 2, right? End of year 1.
Yeah. 2222.
1222. Okay.
Or 222.
So that means it starts from 1222. Plus 2, then will become 1422. So what will be the end of this period? In another year, end of year 3 will be 110 minus 1. It's 10%. It's easy to calculate. Come on. 1422 times 1.1.
Oh, times 1.1. Then 1564.
And then year 3 to year 4. So end of year 4 he withdraw. So year 3 to year 4 doesn't happen, it goes up. So that means it's up and down. So year 3 nothing happened. Up and down. So year 4 he minus. So in the beginning of year 4 will be, in the end of year 4 will be like 1256 minus will become 1164. Right. Year 3, right? Because year 4 goes up and goes down, so it doesn't matter, no change. So in this case, so you see the difference. In this case, on the client A, he get a high return than the client B, despite they all have the same capital being employed, because he has inject and withdraw in the same amount. Inject 200,000, inject 200,000, withdraw 400,000. So basically capital outlay is offset. So the total capital deployed is 1 million, same, but the return is higher. The reason why, because he smartly invest more when the market is down, and then he also invests a bit more when the market starts to go up. That's why his weighted return will be higher. So in this case, do you think the performance is because of the manager? No. Okay. So that's why in calculating return, we should know that the weighted return is determined by investor, not by manager. That means the investor choose a better timing to enter the market. But the manager's actual performance is only 10% within the whole period. So that's why the time weighted is very important. Time weighted will affecting the capital in outflow is so important to calculate the risk and return. So if, say for example, if they injected during this period, say for example, then his return will be a lot lower. he got the wrong timing. So that's why we call it, this is a market timing issue, which I will talk about later when we want to evaluate the performance. So that's why when you look at the client's performance, okay, if the account manager comes to the RM comes to the client and said that, oh, okay, we did very good because we make 16.4 return for you. And the client said, no, not because of you. You only make me 10%. The 6.4% is because me. I choose the right timing to enter. So that's why we call it the market timing impact. So that's why in calculating the time meter is very important on that. The time meter is that because right now he make a good rate when the market goes up. So hope I help to calculate a bit more on the effect. So let's talk about the when we talk about the risk, we also want to know how much the risk. When we talk about return, we also want to know how much the risk the client has taken. That's why in the textbook and also in the CFA, we want to know the standard use the standard deviation as the 3-year standard deviation to calculate whether the portfolio is taking a higher risk or not. However, we have to be cautious to apply standard deviation to the risk measure if the return are not normally distributed. First, and second, for hedge fund and PE, because they are not always mark to market, that's why the volatility will be a lot lower. So when we talk about the volatility, we always apply to something which is fixed. So this is an illustration of something that in the textbook that example of tracking error. So you see that there's different calculating method with different tracking error. And the other way of talking about risk we want to we talk about the downside risk measure. So especially when hedge fund market, we always want to know what are the downside risk of the market. Think about why we want to know about the downside risk. Think about that. If you lose 50% in year one, in 1 year or 1 period of time, how much do you think you would have to get back to 100 to get back your principal?
100% gain.
100% gain. So that's why they draw. But say for example, when you lose 50%, you have to make 100% in order to make it back. When you make 10% or when you make 50%, right, you're 100% to capture it. But when you lose 25%, how much do you need to get back? 32%.
Yeah.
So
Something
that
like
is
that.
a lot easier, right?
Yeah.
So that's why minimize the loss, minimize the drawdown is very important for you to sustain a long-term portfolio. Because say for example, so think about that, I give you another chart, you will understand it clearly. You can use that one. So if I invest in the same strategy, in year one, start from 100. Which one? Which one do you prefer? The red line manager or the blue line manager?
Blue line.
Which one you turn higher?
Red line.
Why you prefer the blue line more?
Scare you to death.
Okay, you're right. So even though the red line has high return, you still prefer a low return. this is the risk. Because the also is that, of course it is theoretical. Because say for example, if gone from here, say from 100 to 115%, this is okay. But when the 115 drop to 90, the drawdown is so huge. Actually, it's quite impossible for him to have a big refi. That means either he takes very exceptional risk leverage or not. Otherwise, if he takes huge leverage, he can go on like that. He may have the possibility to shrink back using this high leverage. That's why you have, when you look at the performance figures, you have to look at, say for example, somebody so easy, what's the average return, what's the total return for the last 5 years? It's no good on that. It's no good for this one. Or if a manager like that he make very high return in the first year and then doing nothing, or performance now so-so, but still make a better return than the blue one. I still don't like it. The reason why, because the volatility of return is so high, because he make everything on the 1 or 2 years, then he do nothing. So that's why if you look at his two numbers, the average return is higher, is the highest, and also the year-to-date return or the cumulative return is also the highest. But however, the swing is so skewed. That's why we call it skew to the left-hand side. So that's why in this case, I still prefer to for a long-term portfolio. This is more predictable. And of course, apart from that, we can also use the benchmark. And you can see the benchmark, how's the benchmark performing. So that's why drawdown. That means the drawdown means how much he. So this is the drawdown. This is the drawdown. This is the drawdown. Drawdown, that means how much he dropped from the high to the bottom. And then how much is recouping the drawdown is how long does it take to recoup the drawdown, which is always we want to evaluate the manager and then whether it's good to choose or not. So the way that people prevent the drawdown is the first priority. We would like to know the time. How do you prevent a huge drawdown? And then the second that I will ask, if you have a huge drawdown, how do you recoup the losses? Because we don't want the client just purely by luck, by betting, by luck to bet. I want him to have a methodology so that he can invest for stay for long term. And a lot of fund managers, when they huge drawdown, they just close the fund and give back the money to the client and do nothing. And also that's why by evaluating that, we have some kind of very common use ratio, we call the Sharpe ratio, to calculate the measure the management return in excess of the TP per unit per portfolio standard deviation, that means for the volatility. It does not measure the managed performance relative to the benchmark, but it measures the total risk and measure the total risk, what is taken, that means the systematic amount of systematic risk. It is calculated by the return of the portfolio minus the risk-free rate and divided by the standard deviation of the portfolio. We call the Sharpe ratio. So the Sharpe ratio, that means it is higher the better. But however, be realistic, nobody can have a very high or 2% Sharpe ratio. I think that 1 point something, 1.2, 1.5 almost is the best I can see. I think the portfolio managers. But for the traditional equity portfolio, actually the Sharpe ratio will be lower than 1. Because of right now, especially in the last couple of years, the volatility of the market index is so high. If you want to achieve a higher than the market return, you have to take an exceptional volatility. So that's why this is the more commonly used ratio that to calculate the return, whether the portfolio is good or not. So Sharpe ratio may not be appropriate for option-based investment because including leverage and hedge fund, that's why it's not good to use. That's another ratio. I don't want to go through here because it's not very common use. So you can have time, you can go to the book. And also this alpha ratio, which is I will explain some of the how to calculate the alpha for the portfolio. You will calculate how the managers outperform the market. So these are the ratios that not very common use. I will skip here. So here comes to the very important part, the performance attribution. When we evaluate a manager, whether he's doing good or not, or I want to know where the portfolio returns. For example, in the previous example, how to distinguish, I make 1.1 million against 1.946 million. Why this is better? So I want to know it. So this is the way that we want to calculate, how we calculate the performance attribution. So decompose what does it mean? That we would like to decompose the overall performance of a portfolio into several attributes so that investor can evaluate manager is able to beat the market with a particular skill. So remember that in the previously I talked about in or out and what. Okay. So just to simplify this, so actually when we decompose the skill, so SAA, remember we call it a strategic asset allocation, we refer to the long-term mix of the asset class. So if you have a long-term portfolio, you stick to the long-term strategic asset allocation, then you get the return of the long-term strategic asset allocation. And then we have the TAA, tactical asset allocation. That means we would like to time the market in case we think that some asset class will be better than another asset class, or some security is better than another security. Refer to the short-term deviation from the SAA. So the security, and then another way of return is security selection is the skill of selecting individual securities within the asset class. Say, when you have the portfolio of equities, like Hang Seng Index or S&P 500. I think that the Hang Seng Index, some of the stocks are bad. I don't want to have that in the portfolio, so I choose my own stock so that I will outperform the Hang Seng Index. That is the security selection. And sector rotation, say for example, if I think the internet sector is better than the healthcare sector, I want to buy more internet sector and then do not want to buy healthcare sector, or I want to short the healthcare sector. Or right now, people like to buy the semiconductors, like the NVIDIA, the Netflix, the better, so that I buy more in the AI related, and then short the real estate, because real estate is bad. So this is the sector rotation. But however, when the market goes up and down, the outperforming sector will be automatically reflected by the index, because the index is usually the broader market index. Either they have a price weighted or market cap weighted. Say for example, right now, if the media performing better, the S&P will perform better because the market weighting is larger and larger. So this is the way for us to distinguish the market timing and the contribution of the market performance between the performance attribution formula. So it looks like so complex, but actually it's so easy. So so our P is the return of the portfolio. So return of the portfolio is the weighted of the asset invested in the portfolio times the return of that asset class in the portfolio. And then you calculate the numbers. And then I will show you some numbers later. We can work an example together. If you want to separate into the overall thing. This is the diagram to show the sector rotation and market timing contribution. And then, so what kind of return is attributed to the market timing, what kind of attribution is returned to the stock selections. I can give you a very good example. Like for example, let's work together on this one example. So consider the following information and determine the portfolio access to the market timing contribution and the sector rotation. So say for example, the benchmark portfolio, as I mentioned, say like if we put 60% in stock, 30% in bond, and cash 10%. So this is the return of the asset class, the benchmark. Remember the benchmark asset class. That means you do nothing. You buy the ETF. You get 5.8, 1.4, and then 0.4. So the portfolio return, if in your own portfolio, I put 70% in stock, very low percentage in bond, 7%, and or 23% in cash. So this is my portfolio return. I invest in the stock, I get 7.28% for the stock, 1.89% on the bond, and cash and 0.48%. So what's that? So these are the calculations, or we can do it together. So for the benchmark, remember we got the time weighted, so you use the return times the weighting, return times the weighting, return from the weighting, and then aggregate together. Very straightforward. Same for the portfolio, return times weighted, return times weighted, return from the cash. Then you will come up with this. Like the benchmark return will be 3.97, and the portfolio return 5.34. So that you will have, that means my portfolio is better than the benchmark by 1.37%. Right? So this is the aggregate. So now I want to know on this 1.37%, how much due to I invest in more stock, less bond, or more cash? Does it because I do the weighting to contribute to return, or because my equity perform better than their equity? So obviously that I invest in equity, I get better return, and then I get in bond and better return. So this is the market timing attribution. So because I have different in weighting times the market return, different in times the market return, so I got 0.31%. And then the security selection, because my performance is better than the benchmark performance on my weighting method. This is no outperformance. So that's why my 1.06. So in this case, that means my technique in choosing securities give me 1% extra return. My technique in overweight equity and underweight bond will give me 0.31%. So total I get 1.37%. So the performance outperform the benchmark, and then I perform both the market timing and sector rotation. So this means I am a very good manager. I choose the better timing, also as well as the better securities. So sometimes we may have a negative market timing event, but have a better stock selection. For example, like what will happen that is that I perform, say for example in this case, if I underweight equity, say from 0.7 to 0.5, and then overweight in bond, increase the bond, I think the overall return will be still better, but my contribution weighting will be a lot higher than the equity. But the point is that because I underweight equity, that's why my return will be contributed by more on asset allocation than security selection. So that's why in the end of the day, you still outperform, but the magnitude is a bit different. So I would say not many people can able to achieve both market timing and security selection. Some people will better on security selection and do less market timing. Some people will do more on market timing and less on security selection. Say for example, if in my analysis, if I always invest in the ETF, so in the ETF I also achieve a 5.81, 1.45, 1.45. But my weighting, say for example, I put 60%, instead of 60%, I put 80% in equity, so my performance will be a lot better. Because equity perform better than bond. Then this will purely on market timing, and then this is a lot of the macro fund would like to do that, because a macro fund will always look at the ETF, but not look at the individual securities. They usually like huge bets on the macro factors. That's why, and when you calculate the market timing attribution, you always use the benchmark return times the difference in the weighting. When you use the security, when you use it, because you use the compare the market, the portfolio return, portfolio asset class return against the benchmark against asset class return. So these two figures should add up equal to this figure. If these two figures add up does not equal to this figure, that means your calculation is something wrong. Sometimes if this is negative, this will be a lot bigger positive to offset. So this is some illustration of that. When you overweight on the outperform security, the overall performance will be positive. If you underweight the outperform security, you will be negative. But if you overweight underperforming security, you will also underperform. So that's why the overweight and underweight will have it's a double-edged sword. If you're good on that, it's good. If not, if you're bad in that, then you will be double hit. So in the end of the day, the overall performance of the portfolio is the most important measure. It must take into consideration of both the risk and its return, i.e. the risk-return trade-off, the risk-adjusted return. So overall performance can be attributed to the different skill of the manager to identify the source of the performance. That's why we would like to identify the source of the performance, and also we would like to compare the peer group, and also compare the benchmarks. So this I will end the Next, I will talk about the manager selection. I forgot to upload the file, so just look at this here first. So we have talked about how to calculate the performance, evaluate the performance of the manager. And then now we go to the one step further is how to select the manager for you to build a portfolio for the kind of portfolio. So some market practice concept I want to know that there's two way of different kinds of investing in the manager. One is called the individual managed account or separate managed account. That means this account and security are in the client's name. And then they tailor portfolio of the goal and the process. And then usually they require a large minimum size and then a limited client per manager file. Let me upload it first. Okay, first is the individual managed account or separate managed account. What does it mean is that if, say for example, I'm the client, I want to invest in Hong Kong equity strategies, but I want you, say like you're a manager, I want you to manage for me. So, but I want everything in my own name, so I open a bank account in the bank, and then I will give you the trading authority to invest for me, to buy and sell. So we call it the separate managed account. That means that it is all under my own name, and then usually it require larger minimum size, and then they will the individual managed account. It always happens in the institutional side, like the insurance company. They want a fund manager to invest for them, but they do not want to go into the commingled funds and then want their own strategy. That's why a lot of individual managed accounts. But nowadays, the private banks can also offer this service to clients because the system can they have a different segregated account in the whole banking system. When they invest, they will invest in all accounts together to the execution. So that's why they can do it at the same time. And then this will require a smaller amount size, and then a large number of clients per manager. And the other thing is that we call it the pool investment vehicle. It is very common in the street and then on the retail bank. Like we have the open-end funds. Like when this is the most common mutual fund offering. Say if you go to the HSBC branch or Standard Chartered branch, you want to buy global healthcare fund, they can show you a number of names like Wellington, Janus Healthcare Fund, Life Science Fund, or whatever. They give you a list of funds. So all these are open-end funds, and then you can buy it any time. they will use the daily market price, daily asset valuation as your subscription and redemption, and then they will charge you a subscription fee, and then all your holding will be similar to everybody. And then you just have to calculate that you will buy and sell through the NAV of the fund on a daily basis. And then you can transfer to other house if you like. So this is called the open-end funds, the mutual funds. The other thing we call the closed-end funds. So closed-end funds, they will sell as a fund. They have an initial size, and then once they subscribe into the total amount, they will not take new investors. That means all will be closed-end with the existing investors. You can only sell your fund units to another investor and pick up your own shares. And this is called the closed-end funds. And the other similar names right now, we call the exchange-traded funds, we call the ETF. This has become more and more common. So exchange-traded funds will be similar to open-end funds. However, it's listed in stock exchange. You can buy and sell during the market opening hours. And they have a very high transparency because usually they will track to a specific index. They track to the performance of the specific index. Like for example, the Hong Kong Tracker Fund, which is managed by Hang Seng Bank, and then they track the Hang Seng Index. Like the S&P SPY, the SPDR S&P ETF, they will track in the S&P 500, something like that. And then the other one, we call the exchange-traded notes. This is perform the similar function as an ETF, but however they trade as a note form. So they don't have, what's different? I think in terms of performance and economic wise, it's quite the same. But usually this exchange note issued by a specific financial institution. So in that case, you're taking the risk of the financial institution to calculate and then the performance. And at the same time, but the good thing is that it is cheaper. Because usually for a closed-end fund or even open fund, they will incorporate a higher kind of a structure fee, like the custody and etc. The next one is the hedge fund. We mentioned before, like similar to open-end fund or some closed-end fund, but they just have a specific strategy. And the next one is private equity funds. These are also collecting of people money to invest in the unlisted shares. The fund of fund is straightforward, is that you set up a fund that invests in all the funds. So right now, a lot of these in China, a lot of these we call it mother fund. So and then they invest in other fund of funds. The good thing is that the fund of fund administrator will perform as help you to select the different managers. The bad thing is that they will incorporate a lot of fees, 2 layers of fees for this fund of funds. So these are the illustration and then there's a mutual fund classification. We have the equity mutual funds, usually benchmark to a specific index. They have the growth fund, growth and income fund, equity income fund, sector fund, and thematic fund. This is quite common on the street. You can always get a lot of these names from the bank. If you go to the bank, you search for the mutual fund, all belong to these sectors. And then fixed income fund, similarly, you have the government bond fund, the corporate bond fund, high yield bond fund, emerging market bond fund, and then all these categorized by different fund managers or asset class. However, nowadays, a lot of the insurance company and also private banks or large international fund house would like to offer these more diversified funds, including asset allocation fund and multi-income fund and liquid fund. These are, and also some hedge fund will offer the liquid format hedge fund. That means instead of the quarterly redemption, half-year redemption, they may give you a more frequent redemption period, like monthly redemption or weekly redemption. So these are the liquid format hedge funds. So, okay, since we mentioned there's so many kinds of instruments and how to select. So I think the first is that according to the textbook, so we have to first, the screen number 1 is to choose your asset class. So and then the asset classes, and then what are the asset classes you want to pick up, what kinds of market capitalization of the class, so whether you're large cap, mid cap or small cap, and what kind of style. These are the first asset class you choose. And then to think of the second screen is that you want to eliminate the bad funds. So why they put it, the elimination of the bad fund is very important. The reason why, because remember that we talked about, we want to minimize the drawdown. That's why, in order not to pick, so of course we want to pick the best performing fund, but however we want to eliminate the bad fund even is the more important than choose the good fund. That's why this is for the more prudent way of wealth management. And then whether the bad funds are concentrated, very concentration of certain region or very sector concentrated, and then whether they are quality, they investment grade bond or junk bond or what's the expense ratio. So these are the ways to really eliminate the bad managers. And also we would also like to check the performance record. That's one of the ways to eliminate. So these are the quantitative measures. So when you put all the databases of these fund managers, then you will eliminate these things out, and then we'll find out it. And there's also some kinds of soft measurements, like what are the fund capitalization, what is the size of the fund, how long did the managers experience, and then also what is the turnover, how much trading turnaround time of the portfolio. Because the higher the turnover of the fund inside of the fund portfolio, the higher will be the expense ratio. Because when they trade, they have to pay a lot of the brokerage fees and transaction fees for the exchange. So that's why if the trading is too high, then probably they will eat up the performance. And the other screen, so for the first two screen is mainly on the quantitative one, and the third screen I would like to put more emphasis nowadays is on the soft side. It's the qualitative side. We call it the 3 P's. Actually, we talk about P, we have 4 P's. So the 3 P's including philosophy, the process, and the people. These are the most important things. So what are the philosophy is that we have to review the prospectus, quarterly annual report, and marketing material to see whether the managers give you their investment philosophy and investment theory. How do they construct a portfolio? How do they pick stocks, and etc. And then we would like to find the third-party independent analysis. This if it's available. Usually when we talk about the hedge funds, what we can do is that we can ask the custodian bank or the fund administrator to get some information regarding the hedge fund, so that we can evaluate whether the fund manager is doing what he said. So that's why it's also important, because some managers will say that they will invest in this kind of environment, they will invest in this philosophy, but in the end of the day you find that what he actually did is not exactly the same as what he said. That's why, because why we want to know that, because especially important for hedge fund managers. Because say for example, if the fund manager said that I will only trading the large cap stocks, and then with the liquidity of so many liquidity, but suddenly when you doing the due diligence, you find that you trade some small caps in order to trade for performance. That means this is not saying what he did. So that's why we have to pay attention, because sometimes he may be right on that, but he may also get wrong. That will incur huge drawdown. And most important of all is that because I choose the fund manager, say for example, because I want him to invest in large cap, because I may have another manager invest in small cap. If the large cap manager also trades small cap, that means my overall exposure on small cap will be a lot higher than my original manager. So that's why we have to know the people, whether he stick to what he did. So that's why we have to review the prospectus and the quarterly report, the annual report. And sometimes you will need to get the data from the fund manager or from the fund administrator, like the turnovers, like the largest position, numbers of holdings, etc. So these are the way we have to interview the managers. what are exactly the process we talk about? So we have to want to know is whether the process are clearly defined, whether the process is consistent and verifiable of the process, such as who makes the decision, whether it's the CIO makes the decision or how many CIOs make the decision, and then where the investment decision come from, and how are the new investment ideas are generated, and then what resources are developed, devoted to research, how many research analysts, and then how do they do research, and what's the manager's training discipline? Do they have risk control, like if it's down by how many percent do they would want to cut position? All these are training disciplines. And then similarly, what's the buying and selling discipline? When do they buying, when do they selling, and what's the firm's compensation policy? Why people will ask, why do you want to know the firm's compensation policy? Do you know why?
Know the potential turnover of their people.
Yes, we want to know the potential turnover, and also we make sure that we compensate the good analysts well, so that you keep the good people. Because remember that financial industry is basically the people business. So that's why we want to know that the compensation policy. If all the compensation goes to the toxic guys, that means sometimes it's difficult for them to keep the good people. And then whether they have training and then on that. And then also, especially for hedge fund managers, that how do they distribute the outperformance carry to the people? The reason why, because if they distribute all the outperformance carry to the people when it is outperforming for the year, that means when the market is bad, they will not have bonus to these people. And then these people will left as well. So think about if you are an analyst in a hedge fund manager. If you're a hedge fund, remember that for hedge funds, what's the specific, very special feature of hedge fund versus mutual fund? Remember his name? High water mark. Remember what's high water mark? High water mark is just a so high water mark is used for outperformance fee calculation. So say for example, say if you start from here, so year one you start from 100 to 110, and your outperformance fee is 10%. So if you go from 100 to 110, so you make 10%, and then the performance fee will be 1%. So client's performance is 109. So if in year two it dropped to 100, so we lose 9. No performance, because here is the high water mark for this portfolio, right? This is the high water mark. So this is below high water mark, so no performance fee. So in year 3, go back to 109, say, do you have performance fee? Still no performance fee, because the high water mark is only payable, the performance is only payable when it is higher than the previous high water mark. So this, when you go from here to here, even though you make 9% for this year, you still have no carry, no performance fee. So only when you go to here, you get the 11%, 1.1 as performance fee. So that means only 2 years you will get performance fee for the team, the manager, right? Because the high water mark is here. So that means only these two parts. This is the performance fee for the fund manager. So think about that. If you have if you work at this firm as an analyst in this year, because if the market dropped by 9%, you'll be pretty depressed because you know that the fund have to outperform a lot, go back to the market before you will get performance fee. That's why if you're a good analyst, you want to jump ship to another company. So that's why the fund manager would like to compensate these good analysts even in a bad year, so that to keep it to sustain. What if, say for example, if the fund goes like that? 7. If you are join a firm, if you're your analyst, the portfolio vary from 100 down to 70%, down to 70. He has to go back to here before you can get performance fee. That means he has to go back from 70 to 100. What's the percentage? It's a lot. So in this case, a lot of analysts will left because they know that the firm will not have bonus for the next couple of years. So that's why this also will illustrate why the hedge fund industry want to control the drawdown very much. Not only because of the fees or etc., it's also because of the want to keep the talent. So this is very important. So that's why the high water mark is a very significant instrument for yes.
May I ask the high water mark was determined at the beginning?
Beginning. So whenever you enter into the fund is your own high water mark. Say for example, if I enter here, my high 109, but when you enter here, the high water mark is 100. So every investor will be different. But however, after a year, every high water will be equalized. The manager will equalize. This is of course a lot of technical, but actually it's like that. So say for example, if I invest here, if the market, if the fund drop from 100 to 70, I buy in here. My high water mark is here. So that's why I keep, if I'm a fund manager, after 2 years my fund dropped 20%. But some investor, new investor has conviction on me. He put in money for me. So that means I have possibility to charge performance fee because my starting point is here for this investor. But for the other investor, I still have to go back to the original mark, original high water mark. Is it clear? So that's why in the finance industry, how the performance is being evaluated, how is the people being paid, will determine his behavior. So just like when we in the you know the
yeah.
cow, the game of the dog hounds competition. They will have the electric rabbit in front of them, so that's why the hound chasing with the electric rabbit. Same for the fund management industry, which is the performance fee that determines the behavior of the portfolio manager. And think about that, if in the hedge fund industry, if there's no performance fee payable to the fund manager will not like to take except extra risk, because no point. Because if you take extra risk, you may lose money, and the money will exceed, and then the money will take away, people will withdraw the money. So that's why these are that's why we would like to ask these questions when we want to know the compensation policy and etc. And then not many good analysts on the same industry. That's why everybody tries to catch the good analysts or the good managers. Or if the good managers not being compensated enough, they will leave and then start up his own hedge fund manager. There's so many new hedge fund managers on the street. So how do we look at the people? We want to know their background and experience of the team, including the staff support and managerial professional growth. And then the lead manager's background and experience and experience for new manager, alignment of his investment style, and how the firm reward the staff, as I mentioned, the talent retention. And then the performance. And then when we evaluate the performance, we want to evaluate the total performance, and then whether it's the benchmark, and then what cycles is performing better, and then what cycle is performing less good. So some managers will perform better when the market goes up. Some managers will perform better when the market goes down, because in terms of the tactics and stock picks. And then during what seasonal factor, etc. And then when we monitor the manager, we want to know we want to whether to the broad index, and then also want to compare to the peer group managers. Like for example, if it's an Asian manager, we want to compare with the Asian long-term managers, whether to the benchmark, and also the watch list. So sometimes we would like to put manager in watch list, and then we would like to possibly buy him if continue to deviate from what he said. So whether the managers are consistent with the philosophy, and then also review and etc. So like for example, like turnover ratio, standard deviation, whether they trade a lot. And then some managers say that I want to hold long-term portfolio, but you find him trading a lot. That means he's not doing what he said. And nowadays we have the Morningstar rating system. But the Morningstar rating system will just give a quantitative assessment of the past performance. So there's no qualitative evaluation. So if you look into the bank's advertisement, you'll see a Morningstar rating, how many stars, but I think this is mainly for reference for his past performance, quantitative but not exactly what he's doing. Because Morningstar doesn't know whether they have changed analysts. Morningstar doesn't know whether they have fired a portfolio manager. So that's why you still have to do a lot of this qualitative process. However, I think that a lot of the retail banks will still like to use the Morningstar, and Morningstar would like to improve this way of evaluating manager to make it more relevant. So these are the Morningstar system. Okay, so I would say that for the open-end funds, practically how people can evaluate choosing an open-end fund managers, that they will rely on a lot of the quantitative method rather than the qualitative method, because for the open-end fund it's quite difficult to get a lot of the qualitative method, and also the quantitative method really determine a lot of the performance of the fund managers. And however, at the same time, we still need to trace some of the qualitative things, including we want to ask if you are big enough, you can go to the fund house and ask the analysts how do they compensate the staff, how do they recruit or retain talents for the team, and also whether they have change in investment strategies or a change in fund management. These are people's changes, and sometimes the long only fund or the open-end fund, they will change the they change the benchmark, which is a very alerting alerting mechanism, because not very often funds will change the benchmark. That means they want to change something or hide something which you have to know about. So that's While for the people, process, and the qualitative evaluation, I think it's more relevant to private equity and hedge funds going forward, because these you require a lot of techniques in terms of doing performing due diligence for the managers. This is more operate, and then because we are not talking about very deep detail on the manager selection, so probably in year 4, Mr. King will talk about more, and then there's still a lot of these qualitative ways to trace managers. But nowadays, because the availability of market, the fund manager information is very easily available, so that's why it's more transparent. And then, and also there's a lot of these semi-mutual funds. What do you mean by semi-mutual fund? Is that some of the mutual funds will give market trading, how to say, is that they will make themselves as a listed mutual fund. You can trade in the financial market or when the market opens, not only on NAV. And also, some of the fund house produce their own index as a tracking media instead of mutual fund, making more transparent. So I think this is a good one for us as a market practitioner to choose managers, more choices for us. So this, I will end the lecture for today, the market selection and the manager selection and evaluation, and then I can spend some time for the midterm exam if you have questions. Okay, you want to go through the questions? remember the question? Okay, let's go through the question 2 first. So, client A is bullish in the Japanese equity market, and then he's recommending the following products. 100% principal protected sharp fee note on wisdom tree Japan hedge fund, DHJ. A 1 year, 100% minimum redemption. Okay. 1 year, 100% protection. Knockout 1 to 5%. And 1-to-1 upside. That means 100% participation. And then if knockout, we pay 7% coupon. So what's the structure? And then question, what's the different scenarios? Okay, what is the structure on that? For principal protected note? Remember? Okay, for principal protected note, this is a zero coupon. Bond plus the call options. So this is the question answer A. So it's a steel coupon bond plus the steel coupon bond. Because steel coupon bond, you use the premium to buy the coupon, buy the option. Return scenario 1 is if there's no knockout occur, that means never touch the knockout, then you have the performance 1-to-1 performance. And then scenario 2, knockout, you get 7% return. 3, if the no knockout, and below 100, you get back 100. These are the 3 scenarios.
Are you going to upload
Yes. Just discuss it first, and then we can upload the answer, of course, later. Yes, you can. For revision.
Is this going to be amplified? Is the calculation?
It's no calculation because this doesn't involve calculation.
No, I mean, part of it, yes, similar things on part of it.
Because part B is no calculation because it's below 100, it's no calculation. It's no calculation there.
I'm talking about things on part B is going to be amplified as well.
Part B.
The part A was multiple choice, part B is.
Part B there's no. This is part B.
Yeah, so is this kind of stuff also going to be amplified?
No.
No?
No. We're not in the same format. Okay, for the final exam, the long answer will be more on the okay, you still have to learn because, okay. Yeah.
If you mean by later part of the lecture, you mean things after structured products or?
After structured products. So you can, okay, but there may be some calculation on it. Maybe. Actually, I forgot all the, because I submitted the test. Yes. Because the university need us to come back before, because they have to evaluate the grade and then pick up marks. Then they evaluate the exam paper whether it's too easy or too difficult. So, okay. So for the long answers, for your easy to preparation, we'll be focusing on the after the structure part. So that's why I mentioned that in the last couple of lectures, including next one and the last one, is pay attention. And then for the MC, it's separate. But I forgot how many questions. So the reason why, because I want to maybe sort of those who have the answer to that. The reason why, because I find this year the marks are quite dispersed. So usually from the last couple of years experience, the grades are pretty similar. The grades. Some are good, some are okay, some are pretty okay. And then most of them are still doing okay. But this year is pretty dispersed. That's why I want to know why, and then to make sure you understand it. But I think I understand some of the reasons. Because this year we have to move some of people. We have 16 something. Last 2 years we have 40 something. That's why the dispersion is more than people. So but still I think that don't worry about it. So we have midterms only accounting for 30% of the and then we do a final, we have the assignment and everything. Sorry? 25. We have the so I think don't worry too much. We can so I would say that maybe you understand why. Okay, two things. First, the midterm exam is the not benchmark, is checking whether you understand the concept and the textbook. And also, I would say that apart from marks, and also it's good for you to learn the financial product. Okay, so, and then I also would like to know what's your expectation of the courses. So I think that for the final exam, I forgot exactly the question, but I think not let put it right. There will be some calculation, but not as much as actually this one is not much calculation. Should be okay. So focusing on one more, I can give you one more.
I guess natural science will include the illnesses.
Some, yeah.
就单纯的想的是。让我来看，我来看一眼哈。
So yeah, it's not if each one, if you have, so I still have some time. If any one of you want to go through the sixth one, not all.
Are we allowed to apply for the office now?
Yeah, if you can't do that now, yeah, you can come to my office. Get the same policy, right, at my office. But if you
Yeah, I
have
think
time now,
so.
you can come over.
Yeah.
If you have time now, you can come over.
If you have a question or
Please, don't take
You use this note to
Yeah. Yeah.
and I wasn't sure how you got me that.
Okay. Okay. I say that no. I say that on the year one, after the year one, it's put in 200,000. So that's why originally from 1 million down by 10, then 90. So we put it 200 become 1 million. This is my manager's performance.
So it's, this one is given.
Different. Because it's they like 190. So that's why it's starting from 100, it's manager, and then 90, at 90 you say, okay, I want to invest, and do cheap. So that's why you start from 90 to 1.1, right? And then after this 1.1 to 30, from 90 to 100, that's why it's gone up by cheap amount. This is the year 2 amount, and then the year 3 amount. In year 3, he decided to add another 200, so that's why it becomes 1.2 becomes a 1.4, and 1.4 become 1.5, so it's gone up by another 10%. But in this time period, he wants to take it out, so that's why he withdraw 400,000. So that's why the 400,000. Year 4 he withdraw 4,000, and then but it doesn't affect the performance of the rest. That's why this is what he totally gets.
Is this also given?
Different because I said if you withdraw 400,000. This is my
It's just a given
assumption.
condition.
No, assumption. Assumption that say for example, if I'm the time A, after investing year 1, I find it drop. I want to add more money. And then after year 2, I find it okay, I get another 200,000. But since I find that okay, because outperform too much, I want to get back my 400,000. That's why if you look at that, the capital flow, I outflow 1 million, outflow 200, outflow 200,000, and then inflow 400,000. My final number is 1.14.
So what would be the absolute return?
Actual return will be 16.4%. Against 10%. But the reason why the outperform because I invest more money when it is cheap. So that's why. But the manager's performance is 10%. But the portfolio return is so. Say for example, even though if you look at the day 1, I put 1 million, and then and then for the time fee didn't take out, they get 1.1. The actual manager performance. So that's why this is something like the SLK. I market timing. That's why we market when the market is bad, when money is good, I take on money. That's why my return. But if say for example, if the day one you put 1.4 here, in the day end you still. So this is the action. Because we want to illustrate the weighting impact. So why the performance is because his weighting on the upside is more than his weighting on the downside. This is the downside we want, but on the upside is 1.1. So the upside.
有魚嘅都係咩嚟㗎？應該係踢得。我唔同格啦，就係。
我唔知佢分唔分。因為跟翻原，因為呢一科技錯咗。
拖唔得拖嘅多。係啊係啊。有冇3字頭啊？有啦。因為佢上日嗱，我哋嘅好消息就係我哋有10%嘅，跟住我哋有3個9個分，即係已經有3%。